Imagine this with me. You pull $20,000 out of retirement to take a trip with your grandkids. You think you spent $20,000. The IRS looks at that same move and starts treating it as if a much bigger piece of income just showed up on your return. Your taxes jump. Part of your Social Security becomes taxable. Your Medicare premiums can get pushed around later. And what felt like one simple withdrawal keeps echoing for years. That is the part most retirees miss. People spend decades learning how to save. Very few ever learn how to take the money back out. I want to walk you through that carefully, because once your paycheck stops, the order you pull money from can matter as much as the investments you chose while you were working. I have seen people spend a lifetime building fine portfolios and then quietly hand away a painful amount of it, simply because they pulled from the wrong bucket first. If you are retired or close to it, I want you to hear this the right way. The question is not, where do I have the most money? The question is, which dollar should I spend first, so I keep more of what I earned and give away less of it by accident? That is the whole game. Once a salary disappears, your need for income does not disappear with it. You still need a paycheck. The difference is that now you must build that paycheck yourself, and if you build it carelessly, the tax code will punish carelessness in a way that feels almost invisible at first, and then very expensive later. Most people above 55 have some version of the same buckets. They have Social Security now or later. They may have a pension, an annuity, or some other fixed monthly income. They have tax, deferred money, usually a traditional IRA, a 401k, maybe an old 403b. They have taxable money in a brokerage account, bank account, CDs, or cash reserves. And if they planned well, they have a Roth account where qualified withdrawals can come out tax-free. Now here's the mistake ordinary people make. They look at those balances, pick the largest one, and start draining it. That feels natural. It also causes some of the worst retirement tax mistakes I see. I do not think about retirement withdrawals as spending from accounts. I think about building an after-tax paycheck that is a different mindset. And when your mindset changes, your order changes. Before you decide which bucket to open first, you need to know where the landmines are. In my experience, there are three that matter most. The first is the Social Security tax trap. People hear that phrase and think I am exaggerating. I am not under current federal rules. Depending on your combined income, none of your Social Security may be taxable, or 50% of it may be taxable, or up to 85% of it may be taxable. For married couples filing jointly, the old thresholds of $32,000 and $44,000 still matter. And those thresholds have not kept up with inflation for decades. That means more retirees keep falling into the trap simply because time passed and prices rose. So a retiree takes what looks like one harmless extra IRA withdrawal on paper. It looks small in practice. That same move can drag more of their Social Security into the taxable column. Suddenly, the effective tax cost of that withdrawal is much higher than expected. They think they pulled one extra dollar. The tax return behaves as if they pulled several. That is how retirees get ambushed. The second landmine is Medicare or MA, those income-related surcharges that hit Part B and Part D. A lot of people do not pay attention to them until they get the bill and start asking, what happened? The answer is usually simple. 2 years earlier, income crossed one of the thresholds, and now Medicare is collecting more every month. For 2025 coverage, those surcharges begin above $212,000 of modified adjusted gross income for a married couple filing jointly. That is why a large Roth conversion or a heavy IRA withdrawal in 1 year can come back later and raise costs in another year. The third landmine is required minimum distributions. This one matters because it is not optional. If you let a large traditional IRA or 401k keep swelling into your 70s, the government eventually decides the withdrawal schedule for you. At that point, the question is no longer how much do I want to take out? The question becomes how much am I forced to take out? And forced withdrawals are usually the least elegant kind. They can pile on top of Social Security, raise taxable income, raise Medicare premiums, and take away the flexibility you had in your 60s. That is why I want you to see retirement the right way. You are not managing one account, you are managing a sequence. The order matters because each account behaves differently under the tax code. Money from a traditional IRA or 401k usually comes out taxed like ordinary income. Money from a Roth, if qualified, can come out tax-free and generally does not show up the same way in the formulas that make retirement income more expensive. Money from a taxable brokerage account is more nuanced. You may owe tax on gains, not the full withdrawal, and long-term capital gains often receive more favorable treatment than ordinary income if you stay inside the right ranges. So $1 from one bucket is not the same as $1 from another bucket. That is the idea people miss. They think money is money in retirement. $1 has a different tax personality depending on where it comes from, and if you ignore that personality, you can make a very costly mess out of a very manageable life. Now let me tell you the general withdrawal pattern that usually makes the most sense for a lot of people, especially in the years between retirement and the heavier tax pressures that show up later. I said usually, not always. I do not believe in lazy one, size fits all advice. But there is a pattern that wins more often than not. You begin with cash and taxable assets in a smart, controlled way. Then you add intentional withdrawals from traditional retirement accounts or partial Roth conversions, up to a tax target you choose. You delay Social Security when your situation supports that decision, and you protect the Roth as long as possible, using it as your most flexible reserve rather than your first source of spending. That is the broad framework. Let me make that practical. Your 60s can be golden years for tax planning. They do not look golden to most people because they are too busy focusing on whether they feel retired. But from a planning standpoint, they are often the best window you will ever get. Why? Because your paycheck may have stopped or shrunk, your Social Security may not have started yet, your required minimum distributions usually have not started yet, and Medicare surcharge consequences may still be manageable if you are planning ahead. That creates a very unusual window in life. Your earned income is lower than it was during your working years, but your forced retirement income may still be lower than it will be in your 70s. In plain English, you often get a stretch of years where your tax bracket is temporarily lighter than it will be later. For example, under 2025 federal brackets, a married couple filing jointly stays in the 12% ordinary income bracket up to $96,950 of taxable income, and the 0% long-term capital gains rate runs up to $96,700 of taxable income. Those are not random trivia numbers, they are guideposts. If you know where those lines sit, you can decide how much ordinary income to recognize, how much gain to realize, and when to stop before a favorable year turns into a sloppy one. A smart retiree uses that window. A careless retiree wastes it by trying to pay no tax now and then pays far more tax later. I never liked that trade. I would much rather pay a reasonable tax on my terms than a larger tax on the government as schedule. So in those early retirement years, what I often want to see is this. Living expenses are covered first from cash reserves and taxable brokerage assets in a measured way. Then I look at the ordinary income brackets and ask a simple question. How much room do I have this year before I move from a tolerable bracket into a painful one? If that room exists, I may use part of it. I may take a controlled distribution from a traditional IRA, or I may convert a piece of that traditional money into a Roth, not recklessly, not for sport, intentionally. The point is not to create tax for fun. The point is to smooth tax over a lifetime. That single idea can save people an enormous amount of money. A lot of retirees think the smartest move is to pay as little tax as possible this year. That sounds sensible. It often is not. If you create a string of near-zero tax years in your 60s by refusing to touch pre-tax accounts, all you may be doing is storing up a larger tax problem for your 70s, when Social Security and required minimum distributions can collide at the same time. I have no interest in winning one tax year and losing retirement. I want to win the whole period. That is why withdrawal order matters more than people think. Let me give you the kind of case that makes this real. Take a couple like Tom and Linda. Tom is 67, Linda is 65. They recently retired. They want to spend $90,000 a year after tax. They do not have a pension. If they claim Social Security now, together they could receive around $48,000 a year. But Tom can increase his benefit materially by waiting until age 70. They have $500,000 in taxable brokerage assets, $700,000 in traditional IRAs and 401ks, and $300,000 in Roth accounts. They are healthy. They expect a long retirement, and like many thoughtful people, they would rather leave something to their children than hand excess money to the IRS. Now, watch what happens depending on the order. If they panic and pull heavily from traditional IRAs every year simply because those balances are large, they can create ordinary income faster than they need to. Later, when Social Security is fully on and required minimum distributions begin, they have a larger pre-tax pile still sitting there, throwing off forced income, which then makes more of Social Security taxable and raises the odds of Medicare surcharges. They feel richer on paper because they preserved other buckets, but they are less flexible where it counts. Now look at the more intelligent version in the first phase of retirement before full Social Security is switched on. They use taxable assets and cash to help fund spending. At the same time, they deliberately fill part of the lower ordinary income brackets with IRA withdrawals or Roth conversions, not to the point of foolishness, just enough to make use of a lower tax window while it is open. That does two beautiful things at once. First, It helps them meet spending needs without overloading one type of account. Second, it gradually shrinks the future required minimum distribution problem before it becomes a problem. In other words, they are not waiting for the tax trap to close around them. They are dismantling the trap while they still have room to move. Then later, when Social Security begins at a higher level and the need for extra withdrawals drops, the whole withdrawal pattern changes. At that point, the Roth becomes more valuable as a reserve because Roth withdrawals can be used for one-off spending needs without doing the same kind of damage to taxable income formulas. That is when the Roth becomes your ace, a roof, a car, a medical expense, helping a grandchild, a large family trip. That kind of spending can be handled with much less collateral damage if you have preserved the Roth instead of burning through it early. That is the sort of flexibility wealthy people respect. And let me say something else that matters. The goal is not to empty one account completely before touching the next. That is amateur thinking. Spending only taxable first, then only pre-tax, then only Roth is simple. But simple and intelligent are not the same thing. Retirement withdrawals are not a straight line. They are a blend. In many years, the right answer is not one bucket. It is the right combination of buckets. That is why the order is less about a rigid rule and more about a disciplined sequence, guided by thresholds. You watch the brackets, you watch the Social Security thresholds, you watch the Medicare lines, you decide how much room you want to use this year, then you pull with purpose. That is how a grown-up does it. Now, I want to slow this down and make the tax personalities even clearer. Because once you understand this part, the rest of retirement planning gets easier. A traditional IRA withdrawal behaves like salary for tax purposes. It is ordinary income. It stacks on top of other ordinary income. It can affect the share of Social Security that becomes taxable. It can move you toward or over Medicare surcharge thresholds. It can feel far more expensive than the number on the withdrawal slip. A taxable brokerage withdrawal is different. If you sell appreciated assets, you are generally taxed on the gain portion, not the full sale proceeds. If the gains are long-term, the federal rate can be very favorable relative to ordinary income when your overall taxable income stays in the right zone. That makes taxable accounts tremendously useful in those early retirement years when you are trying to fund lifestyle while keeping ordinary income under control. A Roth withdrawal is different again. Qualified Roth dollars can give you spending power without the same chain reaction in the tax formulas. That is why I hate to see people raid Roth assets too soon. The Roth is not just another account. It is optionality. It is flexibility. It is a buffer against bad timing. And flexibility in retirement is worth more than most people realize. When markets are down, flexibility matters. When taxes are shifting, flexibility matters. When a spouse dies and filing status changes, flexibility matters. When a big expense appears out of nowhere, flexibility matters. So if you have Roth money, protect it, let it grow, use it carefully, save it for the years when it solves a real problem. Now, I also want to deal with a very common mistake in thinking. People say, I'll just wait and deal with taxes later. That sentence has ruined a lot of perfectly good retirement plans. Taxes later are still taxes. In fact, taxes later are often worse taxes because more pieces of income are colliding by then. Social Security is on, required minimum distributions are on. Sometimes portfolio income is still there. Sometimes one spouse is gone and the survivor is filing single, which means thresholds compress. The room you had in your early retirement years may be gone. I do not like backing myself into corners. If I can use my 60s to create a smoother lifetime tax profile, I will. That is exactly why I want people to stop thinking in calendar years and start thinking across decades. A good retirement plan is not, how do I pay the least tax this year? A good retirement plan is, how do I maximize after-tax spending power and flexibility over the rest of my life? That is the real standard. Let me make the Tom and Linda example even more concrete. Suppose they need $90,000 after tax. Suppose fixed income is still limited because one spouse has delayed Social Security to lock in a larger benefit later. In that phase, the wrong move is to force all spending out of traditional IRAs just because that money is there. The better move is often to take a significant part of spending from taxable funds. Realize gains carefully, and then add just enough ordinary income from pre-tax accounts to use a chosen bracket efficiently. That could mean keeping most of the year inside the 12% bracket, or carefully entering the lower part of the next bracket when the long-term math justifies it. The answer depends on the numbers. But the framework stays the same. Use the lower tax years while you have them. Shrink the future problem before it grows. Preserve the Roth. Then when later years arrive and Social Security is on at a higher level, use required distributions when required. Then supplement intelligently from taxable accounts, and only use Roth strategically when it prevents a bigger mistake somewhere else. Same family, same balances, same retirement, different order, different outcome. That is what makes this so important. A lot of retirement planning looks complicated because people try to memorize rules. I do not like memorizing rules when a few principles will do. So let me give you the principles I would write down on a yellow legal pad if I were sitting at my kitchen table. Do not spend one bucket blindly until it is empty. Use the low-income years in your 60s to reduce the future burden of pre-tax accounts. Watch the old Social Security tax thresholds like a hawk because they are easier to trip than most people expect. Understand that Medicare surcharges arrive with a delay, which means today's decision can become a bill 2 years from now. Treat Roth money as prize flexibility, not casual spending cash. If you remember those 5 ideas, you will already be ahead of most retirees and, frankly, ahead of a fair number of advisors. Now let me bring this all the way down to a practical yearly rhythm, because plans only matter if you can actually use them. At the start of each year, list your fixed income for the coming 12 months. Social Security pensions, annuities, rental income, part-time work. Anything reasonably predictable, then decide what you truly want to spend. Not the fantasy number, not the number that makes you look disciplined. The real number if you want to travel, include it. If the house needs work, include it. If you intend to help family, include it. Then subtract fixed income from planned spending and calculate the gap. That gap is the paycheck you must create from savings. Once you know the gap, pick your target tax zone for the year. Decide how much ordinary income you are willing to show. Decide whether this is a year to do a Roth conversion, a year to stay conservative, or a year to use Roth money to avoid some other threshold. Then fill the gap in the least damaging order. Some years that means using taxable assets first and layering in a modest IRA withdrawal. Some years it means using available bracket room for conversions, even if you do not strictly need the cash. Some years it means tapping Roth to avoid pushing yourself over a line that would cost you more than the withdrawal is worth. And if something large changes in the middle of the year, you revisit the plan. A property sale, an inheritance, a large capital gain, a medical event, a spouse's death. The intelligent retiree adjusts. The lazy retiree stays on autopilot and pays for it. I have spent a lifetime around capital allocation, and retirement withdrawals are capital allocation just in a more personal form. You are deciding which asset to spend, when to spend it, and what hidden cost comes with that decision. The visible cost is easy to see. The invisible cost is what destroys value. That is why I want you to think of retirement income as crossing a river on stepping stones. If you step carelessly, you get wet fast. If you place each step with care, you get across with far more dignity and a great deal more money. You do not need a perfect prediction of tax law to improve your life here. You just need a disciplined sequence. You need to know that IRA dollars are powerful but dangerous if overused at the wrong time. You need to know that taxable accounts can be more useful than they look when managed with an eye toward gains and brackets. You need to know that Roth money is precious because it gives you choices when choices become scarce. And you need to stop thinking that retirement is only about how much money you saved. It is also about how intelligently you release it back into your life. That is the heart of it. You work too hard to spend 30 years building these assets and then lose control in the distribution phase because nobody taught you the withdrawal order. The order can matter more than the funds you own inside the accounts. The order can change whether a trip costs what you thought it would cost. The order can change whether your Social Security gets dragged into the tax net. The order can change whether Medicare becomes more expensive. The order can change how large your future required distributions become. That is real money. That is real peace of mind. And that is why I want you to stop asking the lazy question, which account should I empty first? Ask the intelligent question instead. Which dollars do the least damage this year while keeping me stronger in the years ahead? That is the question that leads to a better retirement, not more complexity. Better judgment. And if you can learn to think that way, year by year, bucket by bucket, threshold by threshold, you will do something very few retirees ever do. You will make your savings work for you on the way out just as efficiently as they work for you on the way in. That is how you keep more of your money. That is how you reduce regret. And that is how you turn retirement from a tax surprise into a controlled, intelligent flow of income built on your terms, not somebody else's.